Today I would like to analyze Johnson & Johnson, one of the largest pharmaceutical companies in the world. If we take a look at the stock price, we can see we are up 4% in the 5-year charts, but from the highs in 2022 we are down around 15%. So we're going to take a look at the financials to find out if this company is a good buy right now. The first thing we can recognize is the huge market cap of 371.64 billion US dollar. This makes Johnson & Johnson the second largest pharmaceutical company in the world by the market cap. We also have a dividend yield of around 3.33%, which we can see here did grow in a very good rate in the last 10 years. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. In 2020, the revenue was around 82.5 billion US dollar. This was a small increase of 0.64%. Then in 2021, we saw the decline around 4.66%. This is something we don't like to see. In 2022, we saw the small growth again around 1.59%. Then we saw in 2023 the better growth around 6.46%. So this is quite decent. And in 2024, we saw the decent growth again around 4.3%. So in the last 5 years, we saw the growth. So it's a check here, but it was not very high as well. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 20.2 billion US dollar. This was a small increase around 1.36% from 2019. Then in 2021, we saw the decrease around 2.1%. This is something we don't like to see. But in 2022, it's got even worse with a decline around 13%. Then in 2023, we saw the comeback around 6% growth. In 2024, we saw the good growth around 8.7%. So it was very inconsistent in the last 5 years, but I would still say we can have the small growth in the last 5 years. So it's a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 19.84 billion. We're going to divide it with the current market cap, 371.64. Then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 5.33%. So I think this is a decent number actually. It's over 4%, so it could be an indication for undervaluation. So it's a check here. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025, it could be around 24.9 billion US dollar. In 2026, around 23.2 billion US dollar. And in 2027, around 23.5 billion US dollar. But I think these numbers are quite high, so I think it's not very realistic. I think we could assume for 2027, maybe around 22 billion US dollar. So let's take this number. Then we're going to divide it with the current market cap, 371.64. So then we would get a different free cash flow yield for 2027. So let me know in the comment if you think this number is realistic. The number we would get would be around 5.91%. So I think this is a good free cash flow yield, and I think this could be again an indication for undervaluation. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we're going to take the long-term debt first. This is around 30.65 billion. Then we're going to add the short-term debt as well. We can see here 4.23, but we need to add this number as well. So all in all, 6 billion. Then we're going to divide it with the current free cash flow, 19.84 billion. Then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 1.84. So I think this is a good number actually. It means a little bit under 2 years we can repay the debt with the free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here 24.5 billion US dollar. So this is a huge amount actually. They can repay the debt with this or to invest in the business. So I think this company has a great balance sheet and we like to see that. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 371.64 billion. We're going to add the debt. The debt was around 36.65 billion. We're going to take minus the cash. We can see here 24.52 billion. So this is the enterprise valuation. Let me calculate this first. So the number we're going to get for the enterprise valuation would be around 383.77 billion. So this is how much the whole company is worth. So we're going to add the debt, we're going to take minus the cash. So now we're going to divide this number with the current free cash flow, 19.84 billion. Then we're going to get the ratio that we're looking for. The number we're going to get would be around 19.34. So I think this is a good number actually. This could be an indication for undervaluation. It's under 25, so the check here. We can also calculate this number for 2027 with the 22 billion. Then we would get a different number again. So the number we're going to get would be around 17.44. So I think this is also a good number. This company could be undervalued right now or fair valued. The next thing we're looking for is a shares outstanding decrease. This means the company buys back their own shares. We like to see that especially we think the company is undervalued. So we're going to take a look and we can see here repurchase of common stocks. Yes, this company buys back a lot of their shares in the last 5 years. We can see here 2020 around 3.2 billion US dollar. So yes, we like to see that. I think we can also say this company can do it because they have a good balance sheet as well. So the check here and it's something positive in my opinion. I would like to give my conclusion about this company, so let's start with a positive. So I think we had a decent revenue growth in the last 5 years. I think the balance sheet is looking very good. This means a low amount of debt and a good amount of cash on hand. So we have a free cash yield around 5.33%, which is also looking quite good. This could be an indication for a fair valuation or for undervaluation. With our free cash flow assumptions for 2027, the free cash flow yield would be around 5.91%, which would look even a little bit better. Then with our enterprise valuation to free cash flow ratio around 19.34, I think this is also a good valuation again, probably fair valued. In 2027, this ratio would be around 17.44, so it would look even better. We also have stock buybacks. This is something we like to see as well because this company also has a good balance sheet. What we don't really like is the small free cash flow growth. So in the last 5 years, the free cash flow didn't grow much. So this is something we don't like to see. So I think this company is probably fair valued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.